going to go into the second part of manufacturing financial statements that we did in 102 and that we're reviewing. There are 4 financial statements: the income statement, the retained earnings statement, which is like the statement of owner's equity that we did in Accounting 101, the balance sheet, and the statement of cash flows. Now, we do these for the manufacturer very similarly to what we did for the merchandiser, and so they're fairly similar. Now, we're not showing in here the statement of cash flows. We'll be working on that separately later in the semester. For the income statement, which is the first financial statement that we do, we need to start out by getting gross profit, which is the net sales minus the cost of goods sold. So to be able to get the cost of goods sold, I need this number called the cost of goods manufactured. And so to do that, I need to stop what I'm doing on the income statement and go do the schedule of the cost of goods manufactured. So here I have my heading, name of the company, what is this, and for the year ended. Now, the schedule of cost of goods manufactured goes through the work in process account. It's the beginning work in process plus what went into the work in process, what got debited to the work in process, which is direct materials, direct labor, and the applied overhead. And so those things that went into the account are added to the beginning balance of the account. Then we subtract the ending work in process balance, and we get our cost of goods manufactured. That's how that number gets there. Now, as we go through this is similar to the previous video. We have to first of all calculate the cost of the direct materials. And so we start out with the beginning materials. We add any material purchases. We subtract the ending materials, and that gives us the cost of the materials used. And then we add in the direct labor and the overhead that was applied. Those 3 together equal our total manufacturing costs. Those are added to the beginning work in process to get the total work in process for this period. We subtract out what was left over in the ending work in process, and that gives us the final cost of goods manufactured. These numbers are all coming from the Excel sheet that was posted in the content tab. We had the sample manufacturing company on the first tab, and here's the Toy Joy. Here's their end of the year adjusted trial balance. So a lot of the numbers that we're going to be looking at come from there, such as the ending finished goods inventory, the ending work in process, and the ending materials inventory are all there. The sales, etc. is there. And we have some additional information on the right. Here's our beginning materials, beginning work in process, beginning finished goods, the materials that were purchased during the year, the direct labor for the year, and the overhead applied for the year. So this is where these numbers are coming from. If you have this printed out and sitting in front of you as we go through the slideshow, you'll be able to see where those numbers are coming from. Okay, so once we have this cost of goods manufactured, then we can go back to the income statement. Here's our heading. Okay, we have our net sales. Then we have to show our cost of goods sold formula, which is beginning finished goods inventory plus the cost of goods manufactured that we just showed on the previous schedule. We add those 2 together. Okay, that's the cost of the goods that were available for sale. This is the cost of all the goods that's sitting on the shelves in the distribution warehouse ready to be sold and shipped out. We subtract the cost of all the finished goods at the end of the period, what's still left over on the shelf, and that will show us the difference between those, will show us the cost of all the goods that did get shipped out, that did get sold. Okay, so now I have my net sales, 835, minus my cost of goods sold, the 600,000, and that gives me the gross profit. Very important number to both investors and creditors. Then we go on to the operating expenses. These are our period expenses. In other words, our expenses related to the office. So here's wages expense. These are the gross wages of the people that work in the office. The wages of the people that worked in the factory are part of direct labor and indirect labor that got part of this cost of goods manufactured. Okay, and so they're part of cost of goods sold. So all these expenses are expenses just from the office building, have nothing to do with the actual building of the product. So here's all of our various operating expenses. We total them up, the total operating expenses, and we subtract that from the gross profit to get our operating income, also known as income from operations. This is also a very important number. All right. Then if we have other revenue, which we did on that Excel printout, we had interest revenue. So any kind of investment or interest revenue is going to be considered other revenue. It's not going to be up with sales, okay, and part of gross profit. So our interest revenue is 430. We add any other revenues to our operating income. Then we have other expenses, and we had interest expense. So that's always an other expense, and we subtract any other expenses from our previous number, and we get 120,584. This is our net income before we subtract out any income tax. Now, in previous classes, you probably showed any income tax expense was just added up with the rest of the operating expenses and not put separately at the bottom like this. But typically in real life with a big company, the income tax expense will be shown as a final last expense. So we get the net income before we subtract out the income tax expense, and what's left over is the final net income, which of course is also a very important number. Also, this is going to carry on to our statement of owner's equity, or in this case, if it's a corporation, our statement of retained earnings. Our statement of owner's equity that we learned about in Accounting 101 took the beginning capital plus any owner investments plus any net income and minus any owner withdrawals and came up with ending capital. And then that ending capital is what we needed to use on the balance sheet. Here, the statement of retained earnings is very similar, except that it doesn't show owner investments. It takes the beginning retained earnings from the beginning of the period, it adds any net income, and it subtracts any owner withdrawals, and it comes out with the ending retained earnings, and that's what we have to put on the balance sheet. So here's our beginning retained earnings. Here's our net income that we just calculated out on the income statement. Okay, here we're subtracting the dividends that the corporation paid out to the investors. The investors are considered part owner, and these dividends then are considered like an owner withdrawal. And so we subtract that out, okay, and we get our ending retained earnings from the end of the period, and that's what's going to have to go then to the balance sheet, 207,974. Here's our balance sheet. I ran out of space, so the second line of the heading I squeezed up on top, but that would normally, balance sheet would be the second line of the heading. And notice that the date on a balance sheet is like the date on a trial balance. It's just the date. It doesn't say for the year ended or for the month ended. These are just balances as of a particular day. This is a classified balance sheet, and so it's made into classifications such as current assets and property, plant, and equipment, which is shown at the bottom. Okay, current assets are all the assets that are going to either be sold, turned into cash, or be used up within 1 year. So here's the cash, is already cash. These government notes are like investments that we can easily sell to get cash. Accounts receivable are the customers that owe us money. We're subtracting out the amount that we think the customers aren't going to ever pay us. Okay, and so this 64,620 that's left over is the amount of the accounts receivable customers we think the customers are actually going to give us in cash. The inventories are all current assets. And again, the finished goods go first, then work in process, then materials. Those are added up. We have some supplies, and we have a prepaid insurance policy that's all considered assets. We learned all about that in Accounting 101. So now I'm going to add all of those assets together, and I get total current assets of $155,024. The next classification is going to be the property, plant, and equipment. And we have land, and then any buildings, and then any equipment. And here, there's different ways to show it. You can show land, factory building, factory equipment, and office equipment, and then show one accumulated depreciation amount. Here, they took each one separate. Of course, we never depreciate land, so the land's out here by itself. Okay, then the factory building minus the accumulated depreciation from the factory building. So the net amount is $140,500. The factory equipment minus the depreciation that we've taken so far on the factory equipment. So that leaves us a net amount of $100,860. Then the office equipment minus the accumulated depreciation of the office equipment. Then I total these up, and I get $295,735. That's my total PP&E, or total property, plant, and equipment. Then I'm going to add that total PP&E to the total current assets that we had gotten in the previous slide, and that gives me the total assets, $450,759. Then I show my liabilities. That's broken down into two classifications. Current liabilities is everything we owe out within the next 1 year. And long-term liabilities are things that we owe out that's going to take us more than a year to pay them off. So here's interest payable, accounts payable, income tax payable. These are all due within the next 1 year or less. Add those up, we get the total current liabilities. We have our long-term liabilities, bonds payable, that maybe takes us 10 years to pay that off. We add our total current liabilities and our total long-term liabilities, and we get grand total liabilities, $147,785. Okay, which is repeated here. Then we go into our stockholders' equity. If this was a sole proprietor, we'd say owner's equity. With a corporation, the common stock, and paid in capital in excess of par, those two amounts are owner investment accounts.